We're going to start off this week with a quick summary. This is days of unsold inventory compared to the 10-year median. This is the current week's data. You can see that Silicon Valley is 24% slower than it typically is for this time of the year. Santa Clara is 8% slower than it typically is. San Mateo County is at 34% slower, and Alameda County is at 27% slower. This one graphic explains to me what's going on with the marketplace. The marketplace is now slower than it typically is for this time of the year on March the 8th. And just let's look at the difference. This is where we were at the end of last year, December 28th of last year. Notice how much more red and how much more white there was. Basically, we went from a normal speed of the marketplace compared to normal to a much slower than the market. Let's get into the normal presentation. We're here to discuss Silicon Valley real estate market for the week ending March 8th. These are the different chapters that we're going to go over. There's a link in the YouTube description where you can jump to the chapters you find most interesting. I'm Richard Calhoun, real estate broker with Creekside Realty. Let's get into the first data slide. This is a summary slide showing 6 metrics. The first 5 are significant. The last one is more a point of interest. What we're doing here is we're looking at the inventory. The blue line always represents the coolest marketplace, the marketplace that favors the buyer. Red favors the seller. Lack of inventory favors the seller. There's less competition. Therefore, there's more offers coming on in each offer. And the gray is the typical marketplace. The typical marketplace is defined as the 10-year median for that particular metric. And this is the current week right here in the middle of the graph. So we go back a quarter and we go forward a quarter. We clearly don't have current data going forward at even 1 week, but we do have the 10-year data because the 10-year data is 2015 through 2024. And that we have plotted out so you know which direction it's going. But the takeaway is last year we had a lack of inventory. You were very close to the red line. Here you can see basically 10 weeks ago, you were at the bottom of the least amount of inventory that we had for the year. And we were also coincidentally the closest to the red line. Then we came up fairly quickly in about 7 weeks ago, we got up to normal. Then basically starting about 4 weeks ago, we went from the typical level of inventory to more inventory, and we're rapidly approaching the blue line. Now the rate of approach appears to be slowing down, but we now have more inventory than you would expect, not more than you would ever expect, but more than you'd expect, because the gray line is the inventory you'd expect. Same concept with the number of offers accepted. Here you can see last year we had less offers than you would normally expect, less offers than the typical. You actually dipped below the least amount of offers you would expect right around 9 weeks ago. And then we came back up, and now we're sort of hovering almost midway between the least amount of offers you'd expect and the typical number of offers. So we're currently sitting at, and here's actually the numbers for you, you're at 91%. So you went from 78% of the offers you'd expect to 91%. So offers have come up. What would that be? I think that's 13%. So your level of offers have come up 13%. But meanwhile, your inventory has come up basically 31%. It's come up from 85%, actually 32% to 117%. So your inventory has gone up much more dramatically than the number of offers. And that's going to show up in the days of unsold inventory, which has gone from 101%, so essentially normal, 1.5% more than normal, to 24% more than normal. So you've gained 22%, which is a slowing of the marketplace because supply-demand balance, as it increases, that means you have more supply for demand, so it's going to take longer to sell. But you went from basically the typical turnover rate to slower than normal turnover rate. And right now, even though the turnover rate is better than it was right at the New Year's, you're closer to the least level. And in fact, if you look at this week, it actually looks like this week is above the blue line. So you're having a slower marketplace, longer turnover rate than you would expect to ever see based on the previous 10 years. Now we look at days on market. This is marketing time. I have a major issue with both average and median, so I have selected to use the third quadrant, the 75th percentile. How long does it take 3 out of 4 sellers to sell? And you can see actually last year, this metric was slower. We were higher, longer time on the marketplace at 39 days than you would expect in the slowest marketplace. We crossed over and then we sped up and we actually got to be hotter than normal. And this would almost be contradictory, but I believe I have an explanation for it. You can see we were hotter than normal for several weeks. And just this last week, we went over from just below the red line to just above the red line. And basically my explanation is the inventory is growing so rapidly that buyers that are out there are being satisfied with the listings that have just come on the market the past week and aren't going back and looking at listings that have been on the market for a week or two. And therefore the days on market number is actually fairly slow, because what's selling is the brand new stuff, and buyers are being satisfied with that brand new stuff. So none of the buyers are going back and looking at stuff that have been on the market for 2 and 3 weeks. It takes 4 or 5 weeks. And then there's not very many of them yet because of the first of the year is still pretty close. And that usually only happens after the seller has done a price reductions. And that leads us into our next metric, price reductions. And this is sort of a measure of sellers' expectations for the market reality. The sellers do their homework before they put the house on the marketplace, and they have an expectation of what sale price they're going to get for their property. They often list their property at, or sometimes even below, what they expect to get for the property, which is one of the reasons we have so much overbidding. But anyway, you can see that the price reductions were essentially very typical. They dipped down to be a little bit greater than normal. Then they were less than normal. But this last week, now that the inventory that started coming on the market since January 1st, since New Year's, has had time to have sellers now do price reductions, you're now starting to take a little bit more than typical price reductions. It's still way less than you would expect in a slow marketplace, but it is more than typical. What are we talking about numbers? Well, a quarter ago, we were taking 1.1% price reduction. Now we're only taking 0.5% price reduction. So the price reductions are very small, and this is average. I like the 10%, the sellers that are taking the larger price reductions, but I put an average here for the summary. And then moving on to the last metric, which is the amount of overbidding. And this is not a comparison. It's just typically a quarter ago, you get 4% overbidding. This past quarter, you had 5.4% overbidding. So you're getting 1.3% more overbidding than you typically do. And that's why you're above the typical line. Now you normally get 5.4%, and we're getting 8.6. So we're actually getting 3.2% overbidding. So we're getting a larger extra overbidding than you would expect based on the 10-year median. That would almost be contradictory with the earlier slides. And what I would put out there is, one, this is a lagging indicator because we have to wait for escrows to close. And it takes a while for buyers to realize the market has changed. And it takes a while for sellers and agents to realize the market has changed. And that's one of the advantages of looking at the detail that I do in this presentation, is you can see when the market has changed and not be someone that's buying a property in the 75, 90 day, 5 week, whatever time frame you want to say, lag time for the market to actually shift, which I believe it has done, to when people perceive it shifted. Here now is sort of the summary of the 3 key indicators. We'll start off on inventory, and you can really see the difference here. Inventory was at 73% of the 10-year median, basically at the new year. Inventory has now grown up and it's at 117% of the 10-year median. So if I'm doing my math correctly, that we go out 17% here and it's 27% here. You add those two together and you have 44% increase in the level of inventory. But meanwhile, your offers have gone from basically 69% to 91%. And again, doing my math on the fly, that's a 20% increase. So inventory has more than doubled the rate of increase as the number of offers. The result of that is days on sold inventory, the balance, the supply-demand balance, which in a free economy supposedly dictates the future pricing, has gone from basically 92% of normal to 124% of normal. Now, granted, it was a little bit higher last week, but keep in mind when you came out of a holiday. When you go into a holiday, DUI is artificially lowered. The week after a holiday, it's artificially inflated. And then the second week after the holiday, which is where we are now, you sort of get the correction, you're back on marketplace. So the trend is up, and this is just the result of the holiday. Moving on to inventory compared to Silicon Valley. So now we're just looking at one metric by itself. We're looking at what's happened. We go all the way back to 2015. So this is January 1st, 2015 on the far left of the graph. We come up through January 1st, 2024 on a condensed scale. And then we have 1 year, 2024, on the expanded scale, which is basically 2 times the scale back here. You can see how much closer together the quarter vertical lines are. Now they're spread out so you can see the trend. But again, you had very limited inventory at the beginning part of the year, right at New Year's. You quickly got up to typical inventory, followed that for a couple of weeks. Now you've broken off and you've gone up. So not only is the rate of inventory climbing, as you can see by the gray line, but the rate of climb is greater than normal, which is a separation from the red line to the gray line and then above the gray line and rapidly approaching the blue line. So inventory is growing, but it's growing at a more rapid rate than it typically does for this time of the year. Here you can see the typical, what we do now is pull out that gray curvy line on the previous graph and just make it a straight line. And what percentage of that gray line, the typical inventory that you expect, is the current inventory. And you can see you went from some number down here right around, what was it, 71, 73%, I forgot already, of normal. And now you're all the way up here at 117% of normal. So you've gained quite a bit of your inventory in a very short period of time. Here now is looking at the number of offers, and the number of offers has gone from the least you'd expect right on top of the blue line to up, and it's still below the gray line, but you've gained a little bit, but your inventory is quite a bit higher. So when we go on the next slide, you'll see days unsold inventory. And I'll just mention, these are not pending transactions, which a lot of people report on. I don't like using pending transactions because a transaction that closes in 1 week only impacts the pending data for 1 week. A transaction that struggles and closes after 10 weeks has impacted the data for 10 weeks. I like going back and just looking at when the offer was accepted and taking that over a 5-week period of time. So every transaction counts for 5 weeks, regardless of how long it's in escrow. Now, if it fails escrow, in other words, it's supposed to be a 6-week escrow and it fails after 3 weeks, I only count that data for the first 3 weeks when it was a valid escrow. Once I realize the escrow fails, it no longer counts as an acceptable offer that's still valid. Here's your pulling out the gray line. So you can see you went from very close to the least offers you'd expect down here at like 69% of offers you'd expect. And now you're up at 91% of the offers you'd expect. So we still have a shortage of offers, not as severe as we did at the first of the year, but we now have a surplus of inventory, which again shows that we don't have an inventory restricted marketplace. And here's your days unsold inventory. Look, you went basically from a very typical marketplace that we had all of 2024. We hit 2025. We rapidly left the gray line, came up and was basically on top of the blue line. We got a little bit under the blue line with the holidays, but now we're right back on top of the blue line. So we're basically having one of the slowest marketplaces that you would expect for this time of the year. Here's pulling out that gray line, and you can see the rate of change. You went from somewhere around 91% of the turnover rate that you'd expect up to some number now around 123% of the turnover rate. So the turnover rate is a higher number. That means the market is slower. It's taking longer to sell the properties. Here's the marketing time. The biggest thing that I don't have any explanation for is this horizontal shift. Clearly the peak happened right on December 28th, where normally it happens halfway through first quarter. It went down, we hit bottom, and we've already turned around for Silicon Valley, and we're starting to go back up. So again, we're several weeks ahead of time because normally this turnaround, assuming it holds, and there's no indication that it's not going to hold, it normally doesn't happen until midway through second quarter. We're only 2/3 of the way through first quarter, so it's happening almost a quarter earlier. So not only has there been a shift horizontally here back in time, which I don't understand, it appears that shift in time is getting stronger than normal. You can see the market typically drops down here, and I will go back and look at my data yet again, just because it's so bizarre, but I'm not aware of any indications that this graph is not an accurate representation of what the market's doing. Here you can see the sharp drop, then the turnaround. And what's noteworthy, we were basically, the only time we were that low before was right before the 2022 slowdown. And when I say right before the 22 slowdown, I'm not sure it was before, because I believe the slowdown occurred on Valentine's Day right here at the peak. And is this right at the peak of the marketplace? So Valentine's Day of 2025 seems to be very similar to Valentine's Day of 2022. Here's just the 10% of the sellers that are taking the largest price reductions. You can see that we went from taking more price reductions to typical price reductions to very less than normal price reductions. You're right up there on the red line, but now all of a sudden you're back down on the gray line and you're below the gray line all of a sudden. So we've gone from more price reductions than normal back here to typical price reductions to less price reductions than normal to typical to less price reductions than normal, all in a 9-week period of time, all since the first of the year. And that's pretty radical changes. But I think what happened is right as the listings came on at the beginning part of the year, sellers are brand new on the marketplace. They're selling before they have time to do price reductions. Now some of those sellers are far enough past New Year's, their property hasn't sold, and now they're doing the price reductions. Here's the change that you can see. You went from slower than normal to hotter than normal, which would be less price reductions, back to slower than normal. So you sort of had this aberration because of, when you look at marketplaces, you basically say you're flat right here, somewhere around 20%, 15% more price reductions than you'd expect. And you just had this perturbation all the way down from 20% more price reductions than you were expecting to something like 15% less price reductions than you'd expect. Here's the average, just so you can see that it's not a phenomenon of looking at the 90%. You can see you weren't all the way down at the blue line by any stretch of the imagination, but you were on the blue side of the gray line, went above, and now you're below. So the swing is not as dramatic on the average as it is on the 10 percentile. Here's pulling out the gray line. You can see that you went from a little bit more price reductions than you'd expect to less to significantly more. So when you're comparing it to a percentage of normal, we're now having more price reductions than we've had all the way back since second quarter of 2024. And the reason I keep comparing everything to normal is I believe the annual cycle of real estate is very strong in Silicon Valley. So it's important to compare to the same time of the year, which is why I use a March 1st fiscal year for my data. I start on March 1st, I go forward a week at a time all the way up through, I think it's February 21st. And then instead of jumping forward 7 days to February 28th, I jump forward 8 days back to March 1st. Here's the frequency of price reductions. Sellers were having the common amount of sellers were doing price reductions. So when the magnitude was greater, that meant that the sellers that were doing price reductions were taking larger price reductions, not that more sellers were taking those price reductions. Then you got down into the new year, and again, this metric is dropping a little bit early, not as dramatically as the first metric that we were talking about, days on marketplace, but maybe a week early. And then it turned around, but now it turned around almost a half quarter early. So something's shifting in the marketplace that's accelerating the curve, and we're slowing down earlier than we typically slow down. Here's that price reduction compared to normal. You can see you went from blue side of the typical line to the hot side, which would be less frequent price reductions. And now you're back up to where you were basically right at the end of last year. Look at this increase here, and this is overbidding. So despite my pessimism on the marketplace based on the data that I'm presenting, the buyers that have been buying so far this year have been overbidding by a greater amount of money than you would expect. You'd expect them to be overbidding down here on the gray line. Now, in a hot marketplace, they'd be up here on the red line, so they're not overbidding that much, but they're overbidding more than you'd expect at a time of the year where it appears the market's actually saying, hey, something's going on and we're slowing down. I think what's going on is because this turnaround has been so quick, it's been basically since the 28th of December, and maybe even more recent than that. So, less than in the past 10 weeks, the market has completely changed. If an escrow is 5 weeks, that's half that time frame. And people's perception, if you've been out looking last year and the market was on fire, and all of a sudden, you're able to buy your house, you're excited, and you go in there and you're aggressive. You don't realize, my God, the market's changed underneath me, and you don't reduce your amount of overbidding. And I think that's what's happening. No way to know for sure. Here's the magnitude compared to normal. So normal, you'd be down here. You can see that we're overbidding by 3.25% more, 3.25% more than we should be based on the past 10 years track record. We have turned around just last week, and this may start coming down now as we see closings happen after the market shift actually was noticeable. Here's the frequency of overbidding. You can see you have more frequent overbidding. So part of the reason your magnitude is higher is not that each buyer is going in and overbidding by more, but more buyers are overbidding. So a larger percentage of the market is overbidding compared to normal. Here you can see, here was the low time right at the end of the year. And again, this has the 5-week lag time for escrows to close. You're getting more and more frequent overbidding. And again, just this last week, we've had a reversal and a little bit less overbidding. So this means the data has come in this last week, and then it goes back 5 weeks for close of escrow. And then I also look in the rearview mirror 5 weeks. Every time I look at offers closed, offer overbidding, I'm not looking at 1 week data because that would be just fluctuating way too much. I use the past 5 weeks. Here's price. Price has been going up very nicely. You can see we bottomed out, we've crossed over, and we're now above the light line of appreciation that you'd sort of expect. And that's typically what the market does. It typically bottoms out right at the end of the year. You can see the V almost every year. We didn't have a V in the pandemic years because the demand was so strong, but now you're on the rise and you're now above price equilibrium line, maybe is a good term. Here now is looking at payments. This is going through the interest rate based on the Freddie Mac national average for a 30-year high balance loan because it's easy to find. Jumbo rates are lower by about 0.5%, I think was the number last time I looked. It's assuming an 80% loan, so the most expensive property would have a payment of about $25,500. It does include an estimate for property taxes and insurance. And these numbers, because jumbo rates are lower, would be artificially high, but it's an easy way to compare the relative payments. And what you do is you see the most expensive home is selling for about the same payment, and the median priced home is selling for about the same payment, and the low priced home is selling for about the same payment. So payments are sort of at the highest level that they've been. Now we're looking at distributions. This is taking a weekly distribution, and you have 2 weeks here. We're really started out focused on this dotted line, the gray line, which is where we were a year ago on March 8, 2024. I have the purple line, the current data, a little bolded. So you can see that it's basically very, very similar. You know, up here at the high end, it's a little bit hotter. Down here at the low end, it's a little bit cooler. So it's basically the same as we were a year ago. And the goal here is the first couple of weeks is which direction you'd expect the market to go based on track record. So let's step in and watch it. So there's the 15th, 22nd, 29th. That's about the peak of the market on the 29th. A little bit of bounce. It's back at the peak on the 26th of April. Now you can see the slowdown. So that's saying that you'd expect days on market increase a little bit more and before it slows down. Then you have this period in the middle of the summer where you're just bouncing up and down. Then you get to Halloween and you slow down fairly dramatically. There's sort of the peak of the slow part of the marketplace, and then a rapid improvement as we get into the new year. So that just sort of gives you an overview of what direction you'd expect days on market to go. Now, it's very possible, even though in the past we went from here to a lower number, it's very possible based on the other data that we're seeing that we may actually have already bottomed out, and this number may turn around and start going up as early as next week when we report this. And again, I need to get in there and change my data from the 7th to the 8th. I know I'm advancing things differently. I know the data is accurate, but the date is wrong. So that should actually be March the 8th. And that's probably going to be on all of the three distribution slides. That's on the second one here, the price reductions. So now on this distribution, we only go from the sellers that are taking the largest 2.5% price reductions to 17.5%. So we're looking at a 15% of the marketplace downshifted by 2.5%. We do that so we don't look at the data errors up here in the top 2.5%. And you can already see that the vast majority of the data is zero, even at 12.5%. Once you get to 10%, so really only 7.5% of the sellers are doing a price reduction at this point in time. But the concept is the same. You can see that a year ago you were very close to where you were this year. And again, this should be 3.8, not 3.7. I gather the data on the morning of the 8th is what it boils down to. I gather the data on the morning of March 1st, 8th, 15th. Anyway, let's step through and look at it. You're seeing you're accelerating. There's sort of the peak of the marketplace. Then it goes down, it jumps back up, and then it slows down. Then you get to sort of the summer doldrums where it really doesn't move very much. The next major movement is going to be right around Halloween, and right about here, you start seeing the price go up. Right there was a big one. And now you're already accelerating right at the beginning of the year, and now you're basically up to the same level that we are right now with some fluctuations. With the overbidding, again, my date on the 2025 is incorrect for both the 28th of February and the 7th of March. Here you can see that the overbidding is a little bit higher on this high end, and it's also a little bit higher on the low end. So I would actually say the purple line is slightly higher than it was a year ago. Stepping through, you can see the market typically accelerates at this time of the year. Right about there is the peak. Now you're cooling off a little bit, and now you're sort of at the summer plateau where it really doesn't move very much until we get, this is going to be close to Thanksgiving because it's the market turns at Halloween right here, but in a 5-week lag time, now you're starting to see the downward trend. Right there is the bottom on January 31st. Again, about 5 weeks after the first of the year, and now we're at current data. And again, that's March the 8th, not the 7th. Here's looking at the active inventory for the 3 counties. So San Mateo County is the smallest county, has the least inventory. Alameda and Santa Clara are typically about the same level, but you can see Santa Clara County has quite a bit less inventory than Alameda County. All 3 were growing. Offers, all 3 are growing. Santa Clara is outperforming. You can see Santa Clara up here. And if you look carefully on the right-hand side, you can see the gray line poking out right about the height of my dot there on the right-hand side. It's plotting out on the right side of the blue line. So Alameda County, even though it has more inventory, is having fewer offers than Santa Clara County. So Santa Clara County is going to have a faster turnover rate. And that's what you're showing. Santa Clara County has a faster turnover rate. San Mateo County is second, and Alameda is the third. You can see this little bump in all of them. That's the holiday impact. It's something that happens. Basically, real estate is an optional event. If people have social obligations, they take priority. So holidays, people leave town. Real estate has less transactions. Marketing time, you can see that we bumped up in all 3 counties. You might argue that no, all 3 are definitely up a little bit from their bottom. And that again is earlier than normal because you can see sometime in second quarter, real early, right at about the same time frame. But this is 2022, right when that market turned. Here you were flat for a longer period of time. Here you were definitely right about the same time as we are now. So end of first quarter is about the earliest you're turning around. So turning around and already being up midway through or 2/3 of the way through first quarter is a little bit earlier for days on marketplace to be increasing. Here's the magnitude of price reductions. Up here is no price reductions whatsoever. These are larger price reductions as the graph comes down. So you can see all 3 counties currently are increasing in amount of price reductions, and this is average. Frequency of price reductions, you're becoming more frequent because you hear 0 line down here. If no sellers were doing price reductions, all 3 have sort of turned the corner and starting to take more frequent price reductions. Here's the overbidding. So overbidding is lagging behind because we need that sale price, but overbidding is still increasing in all 3 counties. It might be starting to roll over because the steepness of the blue line is a little less intense. I wouldn't be surprised if we start seeing more of a hint of a rollover next week. Here's the frequency of overbidding. So how common of overbidding? Basically, 2/3 to 3/4 of the sellers are getting more than overbidding. In Santa Clara County, it's 77%. Alameda County is at 72%. And overbidding is the least common in San Mateo County at 68% of the sellers getting more than their asking price. Here's the long-term appreciation. Santa Clara County is the clear winner. It's something like 115% appreciation since the last 9 months of 2015. San Mateo County and Alameda County are right on top of one another at somewhere around 78 and 79% appreciation, respectively. Here's the pricing. Santa Clara County now is on top of San Mateo. If you look, you can sort of see the orange line bottoms out right there. So this is the level, the orange line, and the blue line is up. So again, we're having another reversal where now the median priced home in Santa Clara County is more expensive than the median priced home in San Mateo County. And Alameda County is down here. They're all fairly similar compared to their 2022 2022 peak and the 2024 peak. The exception is Santa Clara County. Santa Clara County is basically at a record high median sale price, even though that's not true for San Mateo County or Alameda County. Here's the same information on regular paper. The previous was on logarithmic paper that I prefer, but a lot of people like regular paper. The huge advantage of this is you can draw straight lines through the data and see your rate of appreciation. Here's your estimated payments. They're going to be in the same order because it's the same formula. Here now we have the active inventory, and I added in horizontal lines to sort of break up the different counties. So Santa Clara County is the top third, San Mateo County is the middle third, and Alameda County is the bottom third. But you can see that you basically have a surplus of inventory. You know, Silicon Valley as a whole has a 17% more inventory than it typically does for this time of the year. Offers accepted, blue in color, means favors the buyer. Silicon Valley is sitting at 91%. You can pick your favorite micro market area or favorite county and see what the range is. It's not a very wide range. 90% in Santa Clara County, 93% the high in San Mateo County, and 91% in Alameda County. Here's your days on unsold inventory. And again, this is what we started off with, but you can see the blue is favoring the buyer. You basically have a fairly slow marketplace. Silicon Valley is at 24% slower than it typically is. Santa Clara County, 8% slower. San Mateo County, 34% slower than it typically is. Alameda County, 27% slower. So Santa Clara County is the only one close to normal, and that's why it's white in color here for the county data. But the only thing that's really helping it out is Saratoga Los Gatos at 95% and Cupertino and Sunnyvale at 5%. You eliminate these more expensive areas, and the more moderate priced areas are somewhere between 20 and 33%, longer marketing times, longer turnover rate. Here's the days on unsold inventory. Now this looks red in color. You got to keep in mind, Silicon Valley has a very fast-paced marketplace, and there's nothing saying that I picked these colors correctly. I've artificially defined between 6 and 7 weeks to be a normal marketplace. Most people in the country talk about 3 to 7 months being a normal marketplace. Silicon Valley is rarely that slow, because we did actually get up to almost a year inventory in the slowest marketplace. Here's marketing time. So even though the first slides were grim, you're still selling in 2 weeks, and you really can't complain when you're selling 2 weeks. But normally maybe Silicon Valley would have been selling in 10 days. So 2 weeks is significantly slower than 2 weeks. So that's the issue that you have here. The market is slower than it typically is, but it's still a fast-paced marketplace. Here's ask price reductions. You can see there's a fair amount of pink. So sellers are taking very small price reductions. Here's the frequency of those price reductions. So it's a very small number of sellers doing price reductions. I go saturated red at 5% of the sellers doing price reductions, but it goes white at 17%. So all these areas that are showing red in color means less than 17% of the sellers, less than 1 in 6 sellers are doing a price reduction. Here's the magnitude of overbidding. So there's a lot of overbidding. So you might be going, this is mixed signals. It's not really mixed signals. Silicon Valley is a hot marketplace with aggressive bidding, but we're slower than we typically are. Here's that frequency of overbidding. 74% of the sellers in Silicon Valley are getting more than their asking price, so all the way up to 78% in Santa Clara County. 68% is the low in San Mateo County, and Alameda County comes in at 72%. Here's the appreciation. Look at San Mateo County. See how blue that is? So the highest rate of appreciation has been in Santa Clara County and in Alameda County. Basically, this is pandemic related. People were able to work remotely for a couple years there, and the more outlying, more affordable areas became higher desirability, which drove up the prices. Wherever you have the most recent price increases, it's typically the highest overall because of compounding. Here's the prices. In addition to showing just the median number, which most people track, I track the cheapest 10% in an area and the most expensive 10% in an area. So you now know a price range in every given area. And, if you know what the median is, which is the 50 percentile, and you know the 10%, 40% of the homes are between these two numbers, the left number and the center number, and 40% of the homes are between the middle number and the right number. So it gives you, the consumer, a lot better information. Here's a summary of the information that we've gone over. So you can start with your micro market areas on the left-hand side and see your market conditions, or pick your payment or your purchase price range and work back and see what kind of market conditions you're going to experience. Here's the data for Santa Clara, San Mateo, and Alameda counties, as well as Silicon Valley as a whole. You can see that the number of new listings jumped significantly, 17% overall. Overall inventory is only up 6%. Offers accepted is up 8%. Days unsold inventory is down 0.5%. So that's all good signs. Faster turnover rate, but it's still slower than it typically is. You can pick out whatever metric you want and actually see the raw numbers. Here's the offers. The bottom line is the key line. We've now had 5 weeks in a row where we've had the least amount of offers accepted in the past 25 years. Look at the 6th week. It's very close to rolling over. There's only a difference of 12 transactions. There's a very good chance this will become 2025 will become the least number of offers accepted just next week. It's going to take probably 2 weeks for that data to change over. These last two lines are not currently the second worst year. 2008 is the second worst year, but we're within a dozen transactions. Those will fall next week, which is why I went ahead and changed the color this week, because they're going to be there. I'm very confident. It looks like we may have more transactions this year than last year, because I don't expect to have 175 transactions fall through. We've been talking about the Silicon Valley real estate. We will be talking about the Greater Bay Area, 5 regions, 13 counties in the next few minutes. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is here. I represent either buyers or sellers in transactions, basically single agency real estate firm. Looking for people to subscribe if you haven't, and appreciate likes. Also appreciate watching the video, even if you go off and do something else. Gives me a higher ratings on social media, and part of my goal. The blue YouTube up here is where I have an archive of all the past presentations. You can also get there by typing in what I call the green root URL. If you add in the 2025, the current year, to the green root URL Saturday morning at 9 o'clock, you can join the presentation. I would be interested to know if anybody that listens to me archived offline, is there a different time between, say, 9 a.m. Saturday morning and 8 p.m. Monday where you would actually join and participate? Because I would like to increase the live presentation and try to get some questions. The handout is out. It's green root URL plus the letter H for handout. The year 2025, the month 03, the day 08. It's a 67-page PDF of the PowerPoints, and you can get to any specific episode directly. Let me see if I have any unmuted mics. Not seeing any unmuted mics, and I'll do Greater Bay Area. These are the 5 regions that we're going to be going over. This is the first data slide for the Northern California counties. We have Silicon Valley here in the purple, Central Coast in the blue, cities in the orange. Yellow is Central Valley, and gray is North Bay. Inventory is increasing in all 5 regions. Here's the number of offers. Number of offers is also increasing in all 5 regions. This is days unsold inventory. This is the ratio between the inventory and the sales. So you can see how they're increasing relative to each other. And the DUI, the turnover rate, is decreasing, which is a faster paced marketplace. You go from the fastest area of Silicon Valley being about 37.5 days to Santa Cruz, Monterey, the Central Coast being at 72.5 days. This is the time on the market for the 75th percentile. So how long is it taking 3/4 of the sellers to sell? It is noteworthy that Silicon Valley has done an uptick this last week, so it's bottomed out and it's actually increased. It's the fastest still, and it's now at 15 days. But the fact that it's increasing this early is significant. It looks like the cities are starting to level off. The other 3 regions, being the Central Valley, North Bay, and the Central Coast, are all decreasing. And the Central Coast has the longest time to market at 59 days, which is still under 2 months. This is the ask price reductions. This is how the magnitude, it's the average. The gray line here is sort of the typical marketplace where you're in balance. You can see Silicon Valley was in a hot marketplace and left it, and is now back to a balanced marketplace. It appears to be on the decline, which is an increase in the amount of decrease. The cities is clearly increasing the amount of discount. Central Valley looks like it's rolled over. North Bay is flat. Central Coast is more volatile. It's rolled over, but it's been flat this last week. So I would say overall, the price reductions that sellers are taking is starting to increase already this year. Here's the frequency of those price reductions. You can see that they're rolled over in Silicon Valley and the cities. You're flat in the North Bay, basically slightly increasing in the Central Valley and probably increasing overall in the Central Coast. This is the overbid. This is what buyers are doing, how much pressure the buyers are feeling. The most overbidding is actually in the cities at almost 10%. It's about 9.75% overbid, almost 10%. The Silicon Valley is second. It's 8.5% overbid, and that's average overbid. Then you drop all the way down to North Bay, it's somewhere around 101% or 1% overbid. And then when you go to the Central Valley, there's actually a 0.5% decrease. And in the Central Coast area, there's a 2.5% price decrease when they come in with their offers. Frequency of overbidding goes from the most in Silicon Valley, where almost 74% of the sellers are getting more than they're asking for. So 3/4 of the sellers are getting more than they're asking. In the cities, it's 2/3 of the sellers are getting more than their asking price. 45% in North Bay, 35%, that's actually 36% in the Central Valley, which is more than a third. And then you have the last place, the Central Coast. It's somewhere around 27% of the sellers getting more than their asking price. Here's the total appreciation. By far, the most noticeable thing is the cities has gotten the worst appreciation at only 40% since 2015, the last 9 months. You can really see the cities fell out with the pandemic. It initially went up, but then, like everywhere else, then it came back down and is still at its pre-pandemic levels, believe it or not. The highest areas are the Central Valley and the Silicon Valley. Then tied for the middle of the marketplace is the Central Coast and the North Bay, right around 60% appreciation. So you have a range from 40% to 92% appreciation. Here's the sold price. You can see that the cities appears to be now slightly under Silicon Valley. So Silicon Valley is now the most expensive region by a few $1,000s. Then in the middle of the pack is the Central Coast at $1 million even, North Bay at around 750,000, and the most affordable region is the Central Valley at about 550,000. You can see how even though the Central Valley's had a long-term appreciation rate that was second probably to the Silicon Valley, if I'm remembering my slides correctly, you can see it's been basically flat since the pandemic. All the areas have basically been flat since the pandemic with swings in between. Probably the most wide swing is probably Silicon Valley. And it's really not the pandemic, because we're up quite a bit from pandemic. It's from 2021 was sort of the peak year, because 2022, you have this period of time in 2022 where you're above, a little bit at the end of 2023, early in 2024, most of 2024, and now in 2025. So the trend is up, but it's up slower than it was during the first years of the pandemic. Here's the monthly payments. It's going to be in the same order. Just going through a mathematical formula assumes an 80% 30-year fixed at the national average for high balance conforming loan limits, which really isn't applicable in the Bay Area. And jumbo money's been cheaper for a couple decades almost now. So it's a representation that shows you where the payments are going up. The exact amount is an approximation. Here's the tables. I did in bold add in the 5 regions. So you have the 5 regions starting off with Silicon Valley, the cities, North Bay, Central Valley, and the Central Coast, and then the counties that make up each one of the regions above it. Also, just because the media includes it, it's the Bay Area. The current values is the left-hand most column. The middle number is 1 week ago, so you can see that you're up 6% from last week. And then the right-hand most column is where you are relative to last week. So inventory is up dramatically from 5 weeks ago, up significantly from a week ago. Same thing with offers, days unsold inventory, the speed of the marketplace going down as the speeding up of the marketplace. So all those numbers look fairly good. The number that looks still worse, which I don't have for the 5 regions, is the days unsold inventory compared to the previous 10 years. It's just a matter of how much minutia do I want to get into and have different importance at different times of the year. But then you go on time to market, price reductions, frequency of price reductions, magnitude of overbidding, the frequency of overbidding, the rate of appreciation. So you can see the range is a low from the cities of 29% to probably a high of 114% in the Santa Clara County. Pretty interesting. Yes, all boats go up with the tide, but the tide is clearly going up more in Santa Clara County than it did in San Francisco County. I think San Francisco is the lowest by quite a bit, and Santa Clara County is the highest by quite a bit. In fact, second place is going to be down here in Sacramento at a 90% appreciation. Here's the chapters with the link in the below in the YouTube description, so you can jump to the sections that you find most interesting to you. And with that, I'm not seeing any unmuted mics, so have a great week. Take care. Bye for now.